if you're running your business on a $3,000 an ounce gold price and you're selling gold today for $5,000 an ounce, like the margins and the cash flow generation in this sector right now, we've never, ever, ever seen this level of cash flow generation. Everyone, call it from the EU down in terms of, economic participants and countries, into looking at other forms of, current reserve currency, and gold has really stepped into that role.
Dan Wilton's back with us at the VRIC Vancouver Resource Investment Conference. Dan is the CEO of First Mining Gold. Viewers of my channel will recall that we've had Dan on the show previously, and we're going to have a documentary released on this channel very soon, an hour-long show about the mine site in Northern Ontario, which we can talk about in more detail today. So I'm very much looking forward to that, but I'm very much looking forward to getting Dan's reaction to $5,000 gold. It's incredible. Well, thank you for joining us, first of all.
David, it's a pleasure to be here.
It's incredible because I was just thinking about how the gold price has moved. And last year, it was at $3,000. The previous year, exactly a previous year, at VRIC, which is always the end of January, it was at $2,000. So $2,000 at the beginning of 2024, then $3,000 at the beginning of 2025, and now $5,000. That's literally a 50% CAGR in the last 2 years.
Yeah.
What does that mean for this rally? How does that help us make sense of that?
Well, I mean, I think you're looking at the value of gold relative to other things, right? It's always it's like an exchange rate. When you always are looking at it, 5,000 is also a bit of a comment on the U.S. dollar.
Yeah.
I think we've talked a lot in the past about fiscal currency debasement and fiat currency debasement and things like that. I think that is going to continue to be a risk. I think we're sitting in a world geopolitically that, big events last week kind of coming through Davos of just a real sort of breakdown in the traditional world order that we've kind of safely relied on since the end of World War II. And as I see it, David, there's literally nothing that is likely to change even the trajectory of the increase in the price of gold over the next 3 years. We're not going to have a sudden outbreak of peace, right? We're not going to have a sudden outbreak of trust. We're really not going to have a sudden outbreak of order. And we're not going to have an outbreak of government fiscal discipline. That ship has sailed. There is a reckoning that is coming. And so that's, when people ask me, it's funny, we priced our pre-feasibility study that we put out in November at $3,100 gold. That was kind of, call it a 2-year trailing. That was the long-term consensus at the time.
Yeah.
But, I think what we're seeing here is a step change in the price of gold. And I don't think there's anything coming in the next 3 years anyway that's even going to change the trajectory, right?
I wonder if there's a new phenomenon now where gold is positively correlated with bond yields. And what I mean by that is, over the last year and a half, you saw the long end of the curve in the U.S. rise coincidentally with gold, which traditionally in the past has been inverse.
Yes.
And now what we're witnessing is, as soon as governments announce more spending, higher deficits, and deteriorating fiscal positions, the long end of their treasury yield goes up. That was the case in Japan earlier this week when the JGB reached record levels. So I wonder if gold is reacting to fiscal or lack of fiscal discipline, not just in the United States, but around the world. And now investors are turning to another form of security because government debt is literally becoming unreliable.
I think that's 100% the case. And I think it'd be really interesting to go back a couple of years and see when that correlation flipped. Because it's right, historically, gold was always inversely correlated with bond yields, right?
Yeah.
But now I think both are a reflection of the risk. It's very much your bond yields are up because of government funding risk, and gold is up because of government funding risk, amongst other things.
And the fact that treasury prices are falling while gold is going up tells us that there is this, I read on CNBC a couple of days ago, Dan, that the sell America trade is in order. And people are moving away from American assets like treasuries, other forms of American debt, perhaps even on the periphery, some American stocks, and going into assets that are not correlated with the stock market, except it is, Dan. So I'm wondering, because people are moving away from debt to government, to other government debt, or perhaps to gold is acting like a leverage play on the stock market for the first time in history. Does that make sense to you?
First time in a long time, anyway. Yeah. No, absolutely. I think, it's what we haven't reconciled in all of this is, and it's maybe over my head from an economics perspective, but it's that correlation of the stock market to rising yields, right? And that's something that I don't know that we've really seen almost ever. I mean, sometimes I guess you have the inverse, sort of reaction, positive increases in stock price with lowering yields. Right? But the market valuation continues to move now almost in an uncorrelated way with bond yields. Yeah.
Well, you started your career on the banking side, correct?
Yep.
So tell us how the institutional sentiment of gold shifted through the last 3 decades.
Well, let's just go to the last 10 years, because I think that's really when it has happened. So, go back to the beginning of late 90s, early 2000s, when the global trade was gold is shiny dirt and is worth nothing. It's a symbol of mistrust between countries, and don't worry, we have a global order that now provides and enshrines that trust in between countries for mutual benefit, right? Soviet Union had fallen. American hegemony was really kind of solid in the world, and there was a world order with multinational institutions that kind of helped look after it. So we've seen a steady erosion of that, obviously, over those years. But you had central banks fundamentally selling gold from the mid-90s to probably 2015, 2016. And it wasn't really until you started seeing that trade turn, and particularly, China has been one of the first. As you start getting, friction in the first Trump presidency, you start seeing Chinese central bank basically starting to sell U.S. treasuries and buy gold as a reserve currency. And then you see that momentum pick up. And it happened in an accelerated fashion in the last couple of years, primarily because, what the U.S. demonstrated when Russia invaded Ukraine is that they can use that global reserve currency as a weapon. Yeah. And so you as a country don't want to be reliant on something as a store of value that can be used against you, or your ability to transact in it can be taken away from you, which they did with curtailing it from SWIFT and all the other stuff they did at the onset of the Russian crisis. So that pushed basically everyone, call it from the EU down in terms of, economic participants and countries, into looking at other forms of, current reserve currency, and gold has really stepped into that role.
I would be curious, and this is just me musing, I would be curious if and when the Bank of Canada wants to buy gold again. Recall that they sold their gold about 15, 20 years ago.
25.
They were the only G7 country with no gold.
No gold. Well, lots of gold in the ground.
Yeah.
So when they start buying it, I mean, it's pretty easy to just put an export restriction on your gold.
I'd like to get your thoughts on this. A few years ago, I interviewed David Dodge, who is retired from the Bank of Canada now, but he was the governor at the time when they were selling gold. And I asked him why they did that at the time. And he said, and I quote, "Gold is an antique. If we want to hedge against the Canadian dollar, we have other sovereign debt assets to do that with. We don't need a rock."
Yeah, maybe. But, you want to hear the most recent example of that. Read Prime Minister Carney's book. Right? He opens up, that whole book starts with him as the governor of the Bank of England and talking about how he's sitting on the largest, store of gold in the world, sitting underneath in the vaults of the Bank of England, and how it's a relic and it's a symbol of the mistrust between nations. And, he wrote this book in 2020, maybe, because it was just around COVID, maybe 2021. That's not that long ago, and he was talking about, the global world order has put in place these systems of trust that give us the ability to not need to use this relic anymore, except that relic relatively, for a physical asset, costs less to store than just about anything else that would be a physical asset. And that relic also is the largest and most liquid market of a store of value in the world, right? One of the largest and most liquid markets. So it fulfills all of those other requirements of a good reserve currency, but it's the one that is not manipulable by, another country in furthering a fiscal agenda.
One of the more remarkable speeches I heard coming out of Davos at the WEF last week was Ray Dalio going on CNBC and other media saying that the fiat monetary system is dying or is already dead, and he actually expressed his admiration for gold and silver as an alternative. One would not expect Ray Dalio to be a gold bug, but here we are.
Yeah.
What do you think of the notion that the fiat monetary system is turning over?
I think it's a direct result of the lack of fiscal discipline of every one of those countries, right? I think you look at you remember the financial crisis, go back to, 2007, 2008, that financial crisis.
Right.
The U.S. bailed out the global economy from the collapse of the derivatives markets and everything else with an unprecedented $1.2 trillion injection of liquidity.
Yeah.
Right? And that was, it took massive deficits. They ran a $2 trillion deficit that year. And people were like, $2 trillion deficit? In 1 year, $2 trillion? Unheard of. That was to save the global economy. Here we are today. Their average deficit and forecast deficit, before you account for what are going to be increasing cost to finance it over the long term because of increasing bond yields. But that average deficit's now what? $5 trillion, $6 trillion, $7 trillion? The total deficit's at $38 trillion? You're kind of at an area now where this is unsustainable, absent a major fiscal reset in the U.S. And does the U.S. have the appetite to put a 17% VAT on to cover this? I don't know. I
think investors are looking for signs that this may be the top, or if this rally is going to continue. Like you said in the beginning, you think it's going to go even higher. Well, Dan, are there signs that we can draw from with the mining industry? In other words, think back to 2011 when the market peaked in 2011.
Yeah.
What were miners doing at the time that may have signaled a top in retrospect, and can we see if they're starting to do the same thing now?
Yeah, so I spent 5 years as a mining private equity fund manager, and you're looking at what we used to call the resource clock. So there are investment call it tendencies or things that you've seen sort of through every cycle. And when you get to the toppier parts of the cycle, the mining cycle, you will usually see companies pursuing, growth over profitability. And we're not anywhere close to that yet. I think we're in the very early stages of seeing an M&A market pick up in the gold industry for sure. But you also tend to see companies using cash to go buy other companies, right? And they're borrowing. Their balance sheets start deteriorating. We're nowhere close to that right now, David. Most mining companies are still doing their long-term budget planning this year at a $2,800 gold price. Maybe $3,000, but most of the ones that we talk to are $2,800. And sure, that sounds okay to be conservative when, you're doing your budgeting in the fall and it was $3,800, $4,000, we want to be conservative. Let's look 3 years back. But if you're running your business on a $3,000 an ounce gold price and you're selling gold today for $5,000 an ounce, the margins and the cash flow generation in this sector right now, we've never, ever, ever seen this level of cash flow generation.
I think you told me offline, if your company, First Mining Gold, were valued today using $5,000 gold, it would be, 8 times the current market cap?
NPV of our projects would be about $8 billion. Yeah.
So why isn't it being valued that way?
Well, part of it is, where is that long-term gold price settling out in investors' minds? You look at the analyst consensus long-term gold price. Yeah. It's $3,300
Yeah, they
today.
use that assumption. Why do they do that?
Because it takes a while for it to creep up.
Okay.
Basically, they have in a rapidly increasing market, they have an incentive to ratchet it up slowly, because no one wants to be the one who is saying, "Oh, I think gold is going to be $5,000 forever." And look, the implication on that assumption is that every gold mining company is dramatically undervalued.
Yeah.
And I think that's the case. Like for gold producers, if you really think that 5,000 is a level that's a starting point from an increase and not like a peak, and I don't think there's any indication that it's a peak. I honestly don't. But I think if you're talking about that as sort of the foundation point here, you need to look at the valuation of these things, because these large cap gold miners are trading at probably 20, 25% free cash flow yields. Like, we've never seen that. Never, ever seen that. We're not seeing cost pressure run up in the way that we did when gold price ran up in kind of 2009 to 2011. You're starting to see it. Like, the all-in sustaining cost is creeping up.
Yeah.
It always does, because mining
Sure.
costs drop, or mining companies drop their cutoff grades to get more out of existing deposits. But like, I think we're in a point now where, it still takes time for investors' expectations on the equity to catch up with the expectations on the commodity.
Are we going to enter an environment where investors' expectations for how the company should grow will actually put cost pressure up? Like, the companies would be pressured to, let's say, drill more or buy more or hire more, and then, wages go up and bids for equipment go up and all that sort of thing?
Yeah, I mean, I think you're going to see more capital deployed in the industry.
Sure.
But the challenge is, in an industry that's been underfunded for growth for, from 2011 until 2025, call it 14 years of really significant decline in exploration expenditure, in capital development. Like, they have a lot of catch-up to play. And in gold, it's bad, but like in the copper industry, it's almost terminal, right? You get to a point where to fund what people see as the growth in copper takes the development of, dozens of mines equivalent to the largest mines in the industry that haven't been found yet. And so there is a time lag, right? And that's where, hopefully we'll see some of that time pressure on developing projects come down. Well, not the time pressure, but like the time it takes for governments to sanction projects. We'll see that come down. Every government's looking at faster permitting. They are in Ontario, they are in Quebec. I mean, that's important, but you're still talking about like the time lag from that investment being made to that being actual productive capacity. In the mining industry, if you're talking about from discovery to production, it's 15 years. And that's not coming down to 7, right? Maybe it comes down to 13.
Right.
Maybe it goes up to 17. But like, it takes time for these things to develop, which for First Mining, the real opportunity is like with Springpole, and you've been there, it's a project that's significantly advanced. And so we're talking about the main project kind of permitting approvals with that environmental assessment coming like in the next 6 months. Mm-hmm. So investors don't have to wait for that. I think that's part of what's had our share price reacting in this commodity price environment, is it's just starting to feel like, investors are starting to look for those companies that are going to have nearer term milestones, in part because they've made a lot of money on the producers, and the producers are up 5, 6, 7x, but they're taking profits on that and still looking for value. And that's another thing that says to me, we're less than halfway through the cycle where investors are still taking profits off the table and looking for value.
And I think an investor were to approach you and say, well, look, when the gold price has gone up 50% year after year for the last 2 years, the producers as an asset class, if you want to call them that, make a lot of sense to me because their free cash flow goes up proportionally.
Correct.
But what's the value for a company that hasn't produced yet? Are we just leveraging on the fact that the value of the deposit in the ground has gone up?
Leverage to the gold price, because you get that leverage, from the size of the deposits that we have. And I'll tell you what, like, you could have bought our shares in April of last year at 12 cents.
Sure.
And we closed at 69 cents on Friday, right? So we've seen our valuation of ounces in the ground go from $7 an ounce to $49 an ounce, right?
Yeah.
It's a big move, but the reality is it's still, 5 times return from here to get to the basically the average of where our peers trade.
Have investors asked you to, I guess, drill more or faster when the gold price is up? Does it work like that? Can it work like that?
Well, for us, our deposits are pretty well established,
Sure. Yeah.
right? So our risk has always been that risk of getting environmental assessment approval. And yes, they all want you to do it faster. And when you say it's going to take a little longer, they all get really grumpy. But a lot of our investors who are meeting here today have been on this journey with First Mining, many of them for 10 years, right? I've been here for 7. We've kind of moved it as far as we can. And those who've been, we always say being right but early feels a lot like being wrong.
Sure.
And we've been right but early for a long time, and now we're at the point where that value is starting to get recognized, but I think we still have a lot of room for that to run.
Give us an update on Springpole. I visited the site. You gave a presentation on the steps that need to be taken for from now until production.
Yep.
And there's a sizable CapEx investment that needs to be made as well. So walk us through the timeline. Has it shifted since last August, especially with the recent run in the gold price?
Yeah, I think last August we'd have been talking about targeting that approval probably early in Q1 for the federal environmental assessment approval. That's really, those EA approvals really are the big milestone for that project. As you remember, the deposit sits in the bay of a lake, and the big question that a lot of investors have always had is, are you going to get a permit to be able to build those dikes and dewater that North Bay? So, the timeframes have pushed out a little bit, in large part with governments spending the time that they need to working with Indigenous communities. And it's been a very important part of what we've been doing, is providing capacity to the communities to do this work themselves. All the communities that we're working with are in favor of development, but they want it done in a responsible fashion, as do we. And it's just been a really good opportunity for us to really get together and understand, what are the things that they like, what are the things they have challenges with, and, how do we work together to continue to make the project better, which is something that we're committed to do.
In the last year, the U.S. miners that I've worked with were, I guess, miners with projects in the U.S. have commented on how transparent the Trump administration has been in promoting the mining industry, whether it be uranium, which they deem a national security threat if it's mined elsewhere, or other metals, silver, for example, copper, they want to bring onshore as well. Have you felt similar, I guess, shifts in sentiment from the Canadian government in the last year?
Yeah, so I would say Canadian government and then in provincial jurisdictions as well, because a lot of natural resource jurisdiction is provincial. Yes. In short, governments are keen to see mine development. Gold hasn't received the same push or real overt support that critical minerals have in Canada, in part because the gold price is high, and I think the perception is the gold projects don't really need the government help, but it has been, every government that we're working with is focused on shortening permitting timeframes and trying to simplify proponents' sort of process through the system. So we've had great support, at Springpole from a bunch of different government bodies in Ontario, and certainly from Impact Assessment Agency in Canada. Federally, it's been a very open and transparent process with us as well. And we're just looking forward to bringing that process to its logical conclusion. And I think, once we have that EA approval, again, I think that goes a long way to closing that gap between $50 an ounce where we're trading today and $250 where our peers are trading.
All right. Well, we'll look forward to that EA approval. In the meantime, where can we follow your company for any updates, news?
As always, www.firstmininggold.com, or reach out to Paul Morris, our Director of Investor Relations, who is Paul at firstmininggold.com.
Or stay tuned to this channel for more updates with Dan.
Not just that, but you got to watch the documentary that's coming out where you get to see David not in a tie, which will be one of the most unique opportunities that you'll have on this channel. David Lynn relaxed.
It was a very
David Lynn Unplugged.
I will say this was the first mine site I've ever done in my entire life. So
We're so happy.
I'm happy that was my first because that was a great experience. So stay tuned for that coming out. Thank you so much for coming back, Dan.
Pleasure as always. Yeah, thanks,
Thank
David.
you for watching. Don't forget to like, subscribe, follow Dan Wilton and his company.